Welcome to this webcast where we will walk through a simplified example to illustrate how the DRM model is expected to work in practice. It is important to note that the example here is just one of the possible ways the DRM model could work, and entities may also apply other methods as long as they are in line with the principles of the DRM model. In order to apply the DRM model, an entity shall first determine its interest rate risk management strategy. This is expected to be stable throughout the life of the DRM model and documents most of the assumptions and decisions needed. For illustration purpose, we assume an entity manages its entity-level interest rate risk exposure for a 5-year time horizon, using PV01 as the key risk metric, split into 5 yearly time buckets. The entity decides to set its risk limits as a PV01 of -50 to +50 in each of the time buckets, which is effectively the target profile. The entity also decides to manage the change in risks on a monthly basis, which means the DRM assessment period is monthly. The strategy also specifies that the entity manages the interest rate risk based on the expected cash flows, which are rolled out according to the entity's internal models. Although the DRM model is applied continuously, the process itself involves a 6-step cycle for each of the assessment period. Starting from the left-hand side, in the first step, the risk manager decides risk management actions prospectively. This is followed by step 2, in which accountants work out risk mitigation intention, and accountants then construct the benchmark derivatives accordingly, which is step 3. In step 4, accountants assess any unexpected change towards the end of the period, and that will be used to determine the effect of unexpected change, which is step 5. This is finished off by step 6, in which accountants work out the DRM accounting adjustments. Now let's look into each of the steps in a bit more detail. Step 1 is performed by risk managers as they decide the risk management actions at the beginning of the period. They would assess the overall interest rate risk per time bucket and decide to what extent they shall mitigate these risks prospectively through the use of derivatives. Their decision-making is not directly restricted by the DRM model requirements, although it may affect how the risk mitigation intention is determined later in the process. In our example, assume the entity has a total interest rate risk PV01 of +500 in year 5 and no risks in any other buckets. The risk manager decided to mitigate the current net open risk position from +500 to +10 by trading an interest rate swap that has a PV01 of -490 in the year 5 bucket. This is likely to be a forward starting swap in this case. Once the derivatives are traded for risk management purpose, the information feeds through the systems and accountants will start to apply the DRM model. In step 2, accountants first calculate the current net open risk position based on the underlying eligible items in the DRM model. This would be the same as the total interest rate risk exposure excluding derivatives as seen by the risk managers in step 1, unless the risk managers also manages risks that are ineligible for the DRM model. Similarly, the derivatives traded for risk management purpose are documented as a designated derivative in the DRM model. The interest rate risk of the designated derivative also provides an indication that the entity intends to mitigate a PV01 of 490 out of the current net open risk position, which is used as the basis for determining the risk mitigation intention. In addition, accountants also need to ensure the 2 prospective assessments are fully met, and in our example, mitigating 490 PV01 out of the total PV01 of 500 would help the entity to meet its target profile and does not create any new risks. However, if risk managers traded a derivative with a total PV01 of, for example, -510 in year 5 bucket instead, the risk mitigation intention has to be set at 500 in that bucket, which is the maximum possible that would still meet the prospective assessment. Similarly, if the risk managers traded any derivatives in bucket year 1 to year 4, the risk mitigation intention would still be set at 0 in those buckets since there were no risks to be mitigated in the first place. These restrictions on determining the risk mitigation intention are important and ensures the accounting exception under the DRM model is only applied to derivatives used for genuine risk mitigation purposes. Since the risk mitigation intention is a risk exposure within a particular time bucket, it cannot be measured directly for financial reporting purposes. And as a result, the DRM model requires the entity to construct the benchmark derivatives. This is step 3 of the DRM model cycle. The IASB will discuss the detailed guidance on how to construct the benchmark derivatives in a future meeting, but it has tentatively agreed that in principle, the benchmark derivative shall fully represent the interest rate risk of the risk mitigation intention and enable capturing the change in the fair value of the risk mitigation intention over time. In our example, one of the possible ways to construct benchmark derivatives is to construct hypothetical derivatives using the prevailing market interest rate for a similar derivative. To ensure the derivative will have the same risk exposure as the risk mitigation intention, i.e. PV01 of 490, and at the same time having an initial fair value of 0. This would also help to capture the fixed interest rate an entity could achieve in an open market. In step 4 of the DRM cycle, the entity needs to assess whether there are unexpected changes to its current net open risk position at the end of the assessment period. If so, the entity needs to capture the effects of these changes in step 5 of the DRM cycle before working out the measurement and accounting entries required under the DRM model. Step 4 starts with updating the current net open risk position for any unexpected change during this period. These changes are likely to be caused by changes in expectations when the current net open risk position contains expected cash flows, such as early repayments. In our example, assuming part of the prepayable assets previously expected to be repaid in year 5 are now expected to be repaid early in year 4, and there were no other changes. Accountants recalculate the PV01 of the underlying positions and work out the current net open risk position at the end of the period in PV01 terms, which is plus 60 in year 4 bucket and plus 440 in year 5 bucket. For retrospective assessments, this is compared again with the risk mitigation intention as determined at the beginning of the period. In our example, the entity breaches the test in both year 4 and year 5 buckets, but for different reasons. In year 5 bucket, the entity sets a risk mitigation intention that is more than the total risk exposure by 50, while in year 4, the entity fails to meet the target profile of minus 50 to plus 50 due to the unexpected shift in risks. As such, accountants conclude that the entity needs to measure the effect of unexpected change in both time buckets. In comparison, if movements between year 4 and year 5 only change the PV01 by 5 instead of 60, the current net open risk position at the end of the period would be plus 5 in year 4 bucket and plus 495 in year 5 bucket, and that would pass the retrospective assessment, and hence there would be no need to measure the effect of such unexpected changes. As such, accountants may skip the step 5 later. We acknowledge the example here is extremely simplified to demonstrate the key features of the DRM model. As such, we ignore the passage of time when assessing the risks in each time bucket at the end of the period, and also we assume the increase in year 4 PV01 equals to the reduction in year 5 PV01 when the timing of the cash flow changes. In practice, we think these effects could be generated with the help from the entity's existing risk engines and would not change the key principles of applying the DRM model. When the current net open risk position at the end of the period is calculated, it shall only cover the effect from unexpected change to the underlying items that form the current net open risk position at the beginning of the period. New items recognized during the period, such as additional new businesses, are not considered in assessing the unexpected changes, unless they were part of the expected cash flow previously. Step 5 is only applicable when the accountants conclude that the effects of unexpected changes need to be captured, or in other words, when there are breaches to the retrospective assessments. In our example, accountants identified that the entity would need to capture at least a PV01 of -50 in year 5 bucket and a PV01 of +10 in year 4 bucket in order to satisfy the retrospective assessment requirements. During this step, accountants effectively work out the extent of additional risk exposures that need to be considered in addition to those from the risk mitigation intention. In this example, the +10 and the -50 are both expressed in PV01 terms, similar to the PV01 490 of the risk mitigation intention. As a result, an entity needs to consider the change in fair value driven by these unexpected changes for measurement purposes. Although not discussed in detail by the IASB, we think one possible way to measure such change in fair value is by creating some additional hypothetical derivatives. If those derivatives were constructed based on the prevailing market interest rate as at the beginning of the period, with a zero fair value, then accountants could measure the effect from those unexpected changes by measuring the fair value change in the hypothetical derivatives. Entities may also choose to use other methods if they prefer. Entities are expected to keep records of these fair value changes driven by unexpected changes and include these when calculating the DRM adjustment based on the lower-off tests in future periods until fully unwound to zero. The additional hypothetical derivatives created could serve this purpose as a practical expedient, as their clean fair value would naturally unwound to zero over time. The last step of the period is to quantify the measurement and work out the DRM adjustment for the period. This is performed on a life-to-date basis by comparing the cumulative gain or loss on the designated derivative from the inception of the DRM model, and B, the cumulative change in fair value of the risk mitigation intention, as well as the effect of any unexpected changes attributable to the repricing risk from the inception of the DRM model. Applying the DRM model, accountants will recognize the full fair value of the designated derivatives in the statement of financial position, and at the same time recognize an offsetting DRM adjustment as the lower of the two fair value movements in absolute amount to represent the effect of economic offset. The difference between the two are recognized in profit or loss immediately as misalignment P&L. In our example, assume there was a 2 basis point parallel shift in the market interest rate during the period. The designated derivative would have a fair value change of currency unit 980, while the fair value change from the risk mitigation intention and unexpected change are currency unit minus 900. As a result, the accounting balance would be debit derivative balance sheet 980, credit DRM adjustment 900, and credit misalignment P&L 80. However, it's worth noting that having differences in risk terms may not necessarily lead to misalignment P&L. This is because the measurement is performed based on the life-to-date fair value change basis, and as a result, there may be cross-compensation between time buckets. For example, as illustrated in the gray box at the bottom, if the market interest rate change was -2 basis points at year 5 bucket, but -10 basis points at year 4 bucket, the fair value change would be 980 in currency unit for the designated derivatives and minus 980 in currency unit for the risk mitigation intention and unexpected changes. In that case, There will be no misalignment P&L, and the DRM adjustment will be a credit of 980 instead. I hope this example gave you a rough idea about how the DRM model is expected to work. Once the DRM adjustment is calculated for the period under assessment, the process repeats again for the next period as part of the dynamic process. Please feel free to contact us if you have any questions or comments about the material, and thank you again for your attention.